Imagine your house has this uh, massive leak in the roof. Water is just pouring into the living room. Your personal income just took a sudden, brutal hit, and you're actively losing money every single day.
Right, a total disaster.
Yeah. And your immediate gut reaction to this crisis, you go to the bank, secure a massive loan, and you start building a multi-million-dollar, fully integrated smart home extension in the backyard.
I mean, on a purely instinctual level, it makes absolutely zero sense.
Exactly. It looks like financial self-sabotage.
It really does.
Yeah.
When you're bleeding capital in a highly volatile market, the traditional business playbook says hunker down. You freeze hiring, cut operational costs, try to survive this storm.
Yeah, you certainly don't start buying up massive new assets.
Right.
And yet, that is exactly what we're looking at today. For this deep dive, we have a really fascinating stack of sources in front of us. We're looking at internal corporate strategy presentations, maritime analytics reports, and official press releases from a company called Ocean Network Express.
Mostly known as One in the industry.
Right, One. They are an absolute titan in global shipping. And our mission here is to figure out how this sprawling logistics empire attempts to rebuild its physical and digital infrastructure from the ground up, all while navigating a market that is actively punishing them.
And, the stakes here go far beyond corporate finance. This company represents a critical artery in the physical internet of global trade.
The physical internet, I like that.
Yeah, the decisions they make over the next few years will directly impact the cost and availability of almost everything you buy.
So let's get right into the actual numbers, because the whiplash in their financial reporting is really what sets up this whole paradox.
Pretty extreme.
It is. Looking at their first 5 years of integration as a company, they were an absolute juggernaut. The documents show they pulled in a staggering $34.5 billion in net profit.
Which is huge.
Right. But then we hit their Q3 2025 financial report.
Yeah, and the Q3 2025 report is it's a stark reality check. They recorded an $88 million loss for that quarter alone.
$88 million.
Yeah, it's just a massive swing into the red. And the sources point to a very specific, brutal combination of factors driving that loss. First, there's a severe market oversupply.
Meaning too many ships.
Exactly.
Yeah.
There are simply too many massive cargo ships currently in the water and, well, not enough consumer goods being manufactured to fill them.
Which naturally drives down freight rates. I mean, if you have 10 empty ships competing to carry one company's cargo, you have to slash your prices just to win the contract.
Precisely. But the third factor, and this is really the silent killer for shipping companies, is the cost of moving empty metal boxes.
Oh, right.
Because global trade is completely imbalanced. Ships drop off thousands of full containers in places like the US or Europe, but those regions just don't manufacture enough physical goods to send full containers back to Asia.
So they're just sending back air.
Basically, yeah. So the shipping company has to pay to load, transport, and unload thousands of empty metal boxes just to get them back to the factories that actually need them. It's pure overhead, and it absolutely destroyed their quarterly earnings.
Okay, so this brings me right back to the leaky roof analogy. You're losing $88 million because you have too many ships, freight rates are falling, and you're burning really expensive fuel to move empty boxes across the ocean.
Right.
The obvious move is to shrink the operation. But looking at their master plan, which the sources called the 1-20-30 strategy, they are doing the exact opposite.
They're aggressively expanding.
Yeah.
And they're expanding on a scale that is almost difficult to visualize. The 1-20-30 strategy reveals that they intend to scale their core fleet to a capacity of 3 million TEU.
Let's translate TEU for a second, because we see that acronym constantly in these maritime reports.
It's everywhere, yeah.
Right. So TEU stands for 20-foot equivalent unit. If you picture a standard corrugated metal shipping container, like the kind you see stacked on the back of an 18-wheeler truck on the highway, that is 1 TEU.
Right. That's the baseline metric.
So One wants to build a fleet capable of carrying 3 million of those standard physical boxes simultaneously.
Which is just wild.
Yeah.
And to achieve that sheer volume, the strategy outlines a $25 billion investment solely dedicated to their core container shipping business over the next few years.
$25 billion just on ships.
Yeah, that buys the physical vessels.
Yeah.
But that's really only the beginning. They're also committing up to $10 billion to expand into the broader container shipping value chain.
See, this is where I have to push back on their logic a bit.
Okay.
If the entire reason they lost $88 million is market oversupply, meaning the global market already has way too many ships and not enough cargo, Why is their solution to drop 25 billion on more ships and another 10 billion on the surrounding value chain?
It sounds counterintuitive.
Doesn't it? Aren't they just like pouring gasoline on the fire that's burning up their profit
On
margins?
surface, yeah.
Yeah.
Investing $10 billion into the surrounding value chain, which, by the way, involves buying stakes in companies like Atlas Corp, the owner of C-SPAN, and acquiring port terminals, it looks completely contradictory.
Right.
But if we connect this to the bigger picture, you have to look at the physical mechanics of a supply chain bottleneck.
Mhm.
Think about what happens when a massive vessel carrying 20,000 containers arrives at a port it does not own.
I mean, I assume it has to wait for a parking spot.
Exactly. It waits at anchor, sometimes for days, and while it sits offshore, it burns incredibly expensive fuel just to keep the ship's generators running.
Oh, wow. So it's actively losing money while it sits there.
Right. The cargo is delayed, the trucks waiting on land are delayed, the entire logistical network backs up. So by taking that $10 billion and buying stakes in specific port terminals,
Like the ones listed in the sources.
yeah, sources list the NPCT-1 terminal in Jakarta, the RWG terminal in Rotterdam, and the Trepak and Yusen terminals on the U.S. West Coast.
Right. So they're buying the literal concrete.
Yes.
Ah, I see. So they aren't just paying an independent port operator to unload their ships anymore. They own the cranes. They own the actual dock.
Exactly. They secure guaranteed berthing rights. This is classic vertical integration, but applied to physical global geography.
That makes a lot of sense.
Right. By controlling the terminal infrastructure, one physically protects itself from the port congestion and delays that exacerbate all those empty container costs. They're attempting to stabilize the intense financial volatility of the ocean freight market by owning the immovable infrastructure on land.
Okay, so they are willingly absorbing short-term financial pain, that $88 million loss, to fundamentally change their operational leverage. They want to guarantee long-term control over the entire pipeline, not just the water flowing through it.
That's a great way to put it.
But this physical expansion isn't just about launching a bunch of generic cargo ships and hoping the global economy recovers. The corporate documents show a highly localized, almost surgical approach to where they actually put these ships.
You see this vividly in the Trans-Pacific market.
Oh.
One is a core member of the Premier Alliance, which commands a massive 21.4% market share on routes crossing the Pacific Ocean.
21.4% is huge.
It is, but they aren't resting on that overall percentage. The sources detail their launch of the new AP1 route, which is a direct response to very specific import growth trends. They're connecting major Asian manufacturing hubs like Taipei, Shikou, and Haiphong directly to the U.S. West Coast.
But the Trans-Pacific is just one front, right?
Yeah.
The data from Alphaliner, which for those who don't know is essentially the gold standard analytics firm for maritime shipping, it highlights an absolute explosion in one's intra-European market operations.
The Alphaliner numbers are genuinely striking. Within just a 12-month period, one increased its intra-European market share from just 1%, which equated to roughly 11,500 TEU to 2.6%.
Pushing well past 30,000 TEU.
Exactly.
They more than doubled their physical presence. They went from running 8 ships in the region to 17.
And they didn't just add identical ships either.
Right. They deliberately increased the average vessel size from 1,450 TEU to 1,809 TEU. It actually reminds me a lot of how airlines operate those hub-and-spoke models.
Oh, so
Well, you don't use a massive Boeing 747 for a 45-minute flight between two small regional airports. You use a smaller commuter jet. It feels like they're doing the same thing, but with cargo ships.
that is an excellent comparison. One Europe acts as a regional headquarters, allowing them to hyper-tailor their fleet to the specific draft depths of European ports and the volume demands of localized European trade.
So they can be more agile.
Right. A monolithic, centrally managed global competitor sitting in Asia just cannot react to a sudden surge in demand between Rotterdam and Scandinavia as quickly as a localized team with specifically sized regional vessels.
Okay, but wait. This brings us to a massive, glaring contradiction in their entire corporate identity.
The emissions.
Yes, if their core strategy for market dominance involves launching dozens of new, larger ships across regional European routes and these massive trans-Pacific lanes, they are fundamentally increasing the amount of diesel fuel they burn.
Which creates a monumental environmental crisis for the company. I mean, shipping already accounts for roughly 3% of all global greenhouse gas emissions.
And right there in the 1-20-30 strategy presentation, they have this heavily promoted green strategy.
Yeah, they do.
They've made a public commitment to achieve net zero greenhouse gas emissions by the year 2050. And they specifically state this covers Scope 2 and Scope 3 emissions.
which is a massive promise. Let's actually break down what those scopes mean in the physical world because, corporate sustainability reports often weaponize these terms to sound impressive without really explaining the mechanics.
Right. I'm glad you brought that up. What is the actual difference between a Scope 1 and a Scope 3 emission for a shipping company?
Well, Scope 1 emissions are the direct, immediate pollutants. For one, this is the literal thick black smoke coming out of the exhaust funnel of a cargo ship burning heavy fuel oil out in the middle of the ocean.
Okay. Makes sense.
So,
And Scope 2?
Scope 2 covers indirect emissions from purchased energy.
Right.
So think about the coal or natural gas burned by a power plant to provide electricity to one's corporate offices, or the port terminals they now own.
Got it. Okay, so what is Scope 3 then?
Scope 3 is by far the most difficult to control. It encompasses the entire supply chain footprint outside of their direct ownership.
Oh, wow.
Yeah. That includes the carbon emitted by the third-party truck driver hauling the container from the port to an Amazon warehouse, or even the emissions generated by the shipyard that built the vessel in the first place.
Seriously. Promising to bring all three of those scopes to net zero by 2050. I mean, that is a staggering, almost unimaginable undertaking for a company whose entire business model relies on moving millions of tons of steel across water.
It really is. And they also have a nearer-term target. By 2030, they want to reduce their Scope 1 emissions intensity by 70% per TEU kilometer compared to a 2008 baseline.
That's coming up fast.
Very fast.
Right.
And by 2035, they state that zero-emission capable vessels need to account for more than 20% of their entire fleet capacity.
Okay, but you cannot hit those targets by simply running standard engines a little more efficiently or,
Yeah.
asking captains to sail slower.
No, absolutely not. You have to fundamentally change the chemical composition of the fuel powering global trade.
Which brings us to a very specific technological breakthrough mentioned in the press releases. One, working alongside Nihon Shipyard and the Maritime Classification Society, DNV, recently received an approval in principle, often abbreviated as an AIP, for a brand new 3,500 TEU dual-fueled vessel.
Yes, and the fuel it uses is ammonia.
This is the part that really tripped me up.
It's the pivot point. The approval in principle means an independent regulatory body has looked at the engineering blueprints and determined that, theoretically, this ship can be built and operated safely.
I have to admit, I struggle with the logic here. When I hear the word ammonia, I think of the toxic chemical smell of under-the-sink window cleaners or maybe agricultural fertilizer. I do not think of rocket fuel for massive ocean freighters.
It's not the most intuitive leap, I'll say that.
Right. I mean, we hear constantly about wind power, solar panels, massive lithium-ion batteries, revolutionizing transportation. Why is a multi-billion-dollar shipping conglomerate betting its green future on window cleaner?
It comes down to the brutal physics of energy density.
Okay.
If you want to power an electric car to go 300 miles, you need heavy battery. If you want to power a massive cargo ship carrying 20,000 steel containers across the Pacific Ocean, the battery required would be so massive and so heavy that the ship would simply sink.
Oh, right. Or you wouldn't have any room left for the cargo.
Exactly. You'd have absolutely no physical room left on board.
Yeah.
Batteries simply do not hold enough energy per pound to cross an ocean.
Okay, so batteries are out due to weight, but why ammonia?
Well, look at the chemical formula for ammonia, NH3. It's composed of one nitrogen atom and 3 hydrogen atoms. What is entirely missing from that chemical structure?
Yeah, but there's no carbon in it.
Exactly. Because there is no carbon in the fuel, when you burn ammonia in a massive internal combustion engine, it does not emit carbon dioxide. It's a zero-carbon fuel at the point of combustion. That's why heavy industries are pivoting toward it. The sources also mention they are investing in 12 methanol dual-fuel vessels as a parallel hedge, because methanol is another alternative fuel pathway.
Right. Don't put all your eggs in one basket.
Exactly. But DNV explicitly calls the ammonia project a pioneering leap. Mastering ammonia is viewed as the vital, mandatory step for the entire maritime industry to have any realistic hope of hitting that 2050 net zero target.
But there has to be a catch, right? I mean, ammonia is highly toxic to humans and marine life. If you have a spill of heavy fuel oil, yes, it's an environmental disaster, but it mostly floats.
True.
If you rupture a massive pressurized tank of liquid ammonia on a ship in the middle of a port, you could create a lethal toxic gas cloud over an entire coastal city.
And that is the exact engineering nightmare the approval in principle is trying to solve. You cannot just pour ammonia into a standard fuel tank.
I would assume not.
No, you need specialized double-walled piping systems, advanced gas detection sensors, completely redesigned ventilation systems. It is an entirely new operational paradigm for the crew.
Just think about the operational complexity we are building here. One is trying to manage a 3 million TU physical fleet. They are hyper-tailoring route schedules across Europe and the Pacific. They're acquiring concrete port infrastructure in multiple countries.
It's a lot.
And they are trying to physically integrate highly toxic, entirely new ammonia combustion engines into their daily rotation. And going back to the very start of our deep dive, they still have to figure out how to stop losing tens of millions of dollars moving empty metal boxes around the world.
It is a logistical house of cards.
Right. And here is the breaking point.
Yo.
The human brain cannot calculate that math. You cannot put 50 of the smartest logistics experts in a room with whiteboards and expect them to manually route 3 million containers while accounting for global weather, varying port congestion, shifting consumer demand, and the specific fuel requirements of ammonia versus diesel ships.
No, the variables far exceed human cognitive capacity.
Which is why the 1-20-30 strategy relies on building a synthetic brain to handle those variables. The sources outline a major joint venture between One and a company called MTI.
Yes.
They've established an entirely new entity based in Ho Chi Minh City, Vietnam, named Yi-Chih.
And the mission statement for Yi-Chih is fascinating. They aren't building ships. Their entire purpose is to drive an AI-powered digital transformation across the shipping industry.
So QEVO is essentially the digital glue intended to hold this massive, unwieldy physical expansion together.
Exactly.
It's kind of like replacing a human chess player with a chess supercomputer.
Yeah.
I mean, a human port manager might look at a massive pile of empty containers in Los Angeles and think, okay, let's load these onto a ship heading to Taipei next week.
Because that's the obvious next move.
Right. But an AI like the one QEVO is developing doesn't just look one move ahead. It runs millions of predictive macroeconomic simulations simultaneously.
Yes, it can recognize that if you move those empty boxes to Taipei in October, a predicted shift in holiday manufacturing means you'll actually need them in Shenzhen by November.
Which saves millions in fuel costs by routing them directly to Shenzhen in the first place.
And that supercomputer analogy brings us full circle directly back to the $88 million loss that kicked off this entire discussion. The One corporate documents explicitly state that QAVEO is tasked with developing AI solutions to optimize vessel allocation plans, equipment operation, and overall logistics efficiency.
Because AI is the ultimate answer to the empty box problem.
Yes, it is. Human error and the inability to predict macro supply chain gaps months in advance are what lead to ships hauling empty air across the ocean.
It's not just a buzzword.
Exactly. GravVO is not just some flashy technology initiative meant to impress shareholders. It's a direct mathematical countermeasure to the operational inefficiencies that caused their recent financial bleeding. They are building an artificial intelligence capable of foreseeing market bottlenecks and automatically routing their global fleet around them.
And if they actually pull this off, it fundamentally transforms One from a traditional manual shipping company into a predictive, data-driven logistics network.
The completely different beast.
Right. And for you, the listener, understanding this transformation is critical because you interact with this network every single day.
Every day.
Every item in your home right now, the smartphone you're listening on, the sneakers by the door, the replacement parts keeping your car running, it all relies completely on this physical internet of global ocean freight.
And when One talks about their long-term financial goals, they're very transparent with their investors. The documents show they have set a long-term return on equity, or ROE, target of 10% or more.
For those unfamiliar with the finance side, return on equity basically measures how efficiently a company is using the money its shareholders have invested to generate profit.
Right.
A consistent 10% ROE in a notoriously volatile industry like shipping would be a massive signal of financial stability.
It proves the machine works. Furthermore, they are aiming to pay out 30% or more of their net profit as direct dividends to those shareholders. They're promising that this massive, expensive transformation will ultimately yield highly stable, predictable wealth.
So, synthesizing everything we pulled from these sources, the paradox we started with finally makes sense. One is actively choosing to absorb short-term financial losses, like that $88 million hit, because they are playing a much longer game.
Much longer.
They are systematically constructing an interconnected, AI-optimized, ammonia-fueled, vertically integrated global logistics empire.
By buying the physical port terminals, expanding the sheer size of the fleet, investing heavily in zero-carbon chemistry, and
Yeah.
building a predictive AI brain in Vietnam, they are transcending the basic definition of a shipping line.
Right.
They are attempting to engineer a sustainable, privately owned global infrastructure.
It definitely changes how you look at those massive rusted metal boxes sitting stacked up at a port. But it also leaves us with a rather profound question to consider.
Yeah.
Well, we started this deep dive talking about a homeowner taking out a loan to build a massive smart home extension while the roof was actively leaking.
A really risky expansion during a crisis.
Exactly. But what happens when that single smart home extension becomes so efficient that it eventually buys up the entire neighborhood? If global trade completely transitions to AI-managed alternative fuel fleets owned by massive corporations that also own the very concrete ports those ships dock at,
That's a lot of power.
right. Do we risk creating unbreakable monopolistic bottlenecks in the physical Internet of Goods? Or, considering the ticking clock of climate change, is a highly centralized, incredibly wealthy, AI-driven mega network the only realistic way human beings will ever coordinate a truly green, net zero global economy? Something to think about the next time you click Add to Cart and expect it on your doorstep in 2 days.